Over the past decade since joining S&P Global, the iconic financial information and analytics firm, Martina Cheung has risen up the ranks from VP Operations to Chief Strategy Officer, and now President of S&P Global Market Intelligence, where her remit includes driving S&P Global's enterprise-wide growth strategy in environment, social, and governance data, ESG, as most of us know it. Over much of that time, Green Business partnered with S&P to produce our annual State of Green Business report, and more recently, the GreenFin events that Pete was just mentioning. So I couldn't think of anyone better to talk about ESG, the present and future, than Martina Cheung. So welcome, Martina.
Thanks, Joel. It's great to be here, and thank you also for the wonderful partnership. We very much enjoy the work we do together.
Likewise. So, what happened to ESG in 2020?
Well, 2020 was a monumental year for reasons that we all recognize and can see very clearly. But there was a lot going on in parallel around this in the world of ESG, and so, you know, there's definitely a sort of a cause and effect implication for what's happening in the real world. Pete said I was going to give the point of view of Wall Street, but I think it's actually Main Street and real world as well. So, you can think about the pandemic, which I'm sure has been talked about quite a bit already this week. But when we look at the implications of the pandemic on businesses, on company sectors, on communities, and especially parts of the communities that are disproportionately affected by the pandemic, it becomes very relevant in the context of ESG. We also had a year that was record-breaking in terms of the number of extreme and severe weather events. In the US, for example, it was 22 of them, over $1 billion. That was a record. The last record that we had for a number of events with costs over $1 billion was 16 climate and severe weather events. And in aggregate, the total there for all those events in 2020 was about $95 billion. Hundreds of lives lost, and countless more individuals injured, businesses damaged, et cetera. And so all that plays into how individuals, companies, sectors, governments think about how to plan for this more in the future, how to manage the risk around it, how to be thoughtful and deliberate in reducing exposure, and you see that playing through in some of the ESG markets also. And then I would also say that we've seen an incredible amount of focus in social equity. I've heard some of the reference to the conversations that took place yesterday in the conference, and we've looked at this from a variety of angles as S&P Global, including a very important angle, which is that the vast majority of the studies that we have done show that companies who are more diverse and have more, gender diversity and otherwise in the leadership teams actually perform better. And so these are all very important topics, not just socially, but also in the context of the markets. And it's played out in a number of ways. I'll take a pause if you want to ask another question.
Well, I got lots of them, but I do want to hear how it's played out. But let me ask you specifically, it feels like under your watch that ESG has risen within the ranks of S&P. Why is S&P prioritizing ESG? What do you see as the big need that you can fill?
Well, we've actually been in ESG in some of our products for many, many years. The Dow Jones Sustainability Index is 2 decades. First major sustainability index, and we've been looking at rating green investments within the rating agency, for example, for many, many years as well. I think as some of the topics that I mentioned, the implication of whether it's climate risk, whether it is social equity, governance, and stronger representation from a governance standpoint, both race and gender. As we see that play out, the real effects of that on the markets, on companies' performance, on sectors, and the policies that are needed to address them become actually quite significant. And so our clients are turning to us and saying, what information do you have that can help us as we have to make decisions, as we have to comply with regulations, as we look to raise capital, and that came through in some of the comments that Pete made as well. And it's table stakes for a company such as ourselves, and we're now looking at where we need to double down to add more value for our clients as part of that.
So where are we? One of the things we hear from so many people who are watching is this cacophony of standards. I'm sure we could all recite in unison GRI, CDP, TCFD, SASB, and now IFRS is the rising up the ranks. Where do you see us going in terms of getting to one standard, one simplified way that companies can be reporting to you and everyone else?
Well, I think it's a few years away. And we have one of the themes that we're watching very closely in both with the voluntary standard setters as well as with regulators and policymakers is a convergence around certain themes. So we have seen, for example, SASB merging with IRRC. We see further convergence in the voluntary standard setters, which will really help to bring a lot of those metrics and frameworks together. In addition, we're seeing a lot of regulators actually embracing the green taxonomy that was developed out of the EU that looks at, what activities can be considered green, for example, if you're an investor looking at your portfolio. And we also see a lot of the major financial policymakers like the European Central Bank, NGFS, et cetera, looking at climate risk, putting their support behind frameworks such as the Task Force on Climate-Related Financial Disclosures, or TCFD. So we're at a moment where there's some convergence and coalescence. The IFRS work is critical, and it's critical for the point that Pete made, which is that the CFO has to come in stage right and actually take a lot of the implications of this and figure out how does that impact the long-term planning of a company. How does it impact, the risk that a company faces of disruption or damage to physical assets, for example? And so the IFRS standards will, I think, be a very important catalyst for further standardization as we begin to see this convergence more and more in what's out there today.
I imagine one of the tension points is that between having enough data and having too much data. So not every company reports every data point that S&P, for one, compiles about companies. And then there's probably lots of data that's irrelevant to, at least for your needs. How do you balance that? And what would you like to see from companies?
Well, we have a point of view, I would say, that is, fairly consistent with a number of other providers in the market, that we first and foremost prioritize data that is needed to actually demonstrate financial materiality or to measure the financial impact of some of these risks, be they climate risk on physical assets or supply chain disruption, and the long sort of list of challenges that you're now forced to measure and report against. And so we're prioritizing the data sets that are in service of examining the impact of financial materiality, as well as enabling our customers to report against the various different disclosure frameworks that they're likely to have to comply with.
You, S&P, credit rate nearly every company watching. What are you learning about how companies are viewing sustainability as both a risk and an opportunity?
That's a great question. Just to take a step back, I would say disclosures have been increased, quite dramatically. We now have the vast majority of the S&P 500, for example, providing disclosures. I would say that intensity is going to increase, particularly as a number of governments in 2020 mandated disclosures. For example, New Zealand, Canada, the UK mandating TCFD. And so, we definitely see the companies replacing a much higher emphasis on this. I suppose maybe a couple of things that I would say that the early focus has tended to be quite a bit around risk, and a lot of that has to do with the fact that we're all grappling with the real world challenges of climate risk, for example, and implications for for companies' operations and impact to business. But I would also say that we've seen a number of companies who have seen positive benefits, whether it's cost reduction, for example, from lowering the number of data centers that they have and moving to the cloud, which of course reduces carbon emissions, but also provides real operational benefits to the company as well. So there's a good mix there. I think on the growth side, just also stealing that data center example, we've seen a number of large technology companies actually using some of the power they generate from data centers that they still have, and actually repurposing and reselling some of that on the grid, for example. So there's a lot of opportunity in interesting and unusual ways, I would say. Probably the next evolution here is going beyond the disclosures to more detailed and precise ways of looking at the financial impacts. The first and second years of TCFD, you saw with a lot of companies, it was even with our own at S&P, there was quite a maturing, if you like, in our second TCFD report over our first TCFD report, and when we just announced our own net zero commitments last week. So we're going to see more of that. And as we see that, I think we'll see more of the opportunity piece of it play out also.
Well, that's interesting. So what will companies have to do differently in order to offer, as you call this, more precise kinds of reporting and data?
Well, there are a lot of points of view on this. So, I would say just thematically, certainly for anyone who has looked at if you've examined your peer set and compared your TCFD reports to those of your peer set or your disclosures more broadly, even if you're using a GRI framework or SASB, you'll probably find a fair amount of difference in how you might have approached the application of the framework vis-a-vis your peer set, for example. And so I do think there's going to be some additional help from a regulatory and a policy front on this over time, maybe not immediately, because everybody's at the very, kind of first or second inning on this. But I would hazard a guess at saying that there would be more thoughtfulness at the analytical measures that are used, the certification of targets, science-based targets, for example. More tracking and assurance around kind of carbon emissions and things like that, and these are all things again that we have identified for ourselves within S&P Global as ways in which we can continue to improve.
Yeah. One of the things that we're going to be talking about at our Greenfin event in April, as we have at the past too, is this challenge between companies and investors, with investors feeling that for all companies that report, it's not always the information that they need to make risk-based asset allocation decisions. What are you hearing from investors in terms of what's available and what they need?
We're hearing similar points of feedback, I would say, and that goes to to sort of what we would see in improved analysis, greater data standardization, and and metrics that are provided in disclosures. So we've seen quite a bit of I would say inconsistency both within and across sectors. And not just because sectors are impacted in different ways. So there's definitely going to be, I think, more advancements in that. To overcome that, some of what S&P does, for example, is we look at external sources of data that can actually be linked to companies, whether it's predicting or at least having some view on the implication of extreme weather on a particular set of companies in a particular geographic area, for example, and those sorts of data can be helpful to investors also. But the interaction between investors and portfolio companies is going to become more focused and more precise on this.
So before I let you go, what's the one thing that you would think would like to share with our sustainability professionals inside big companies that you wish they knew that would help you help investors and ultimately help them as well as they traverse this whole ESG path?
I don't remember if it was Pete or yourself who mentioned the notion of kind of a green balance sheet, or I think the phrase was something along those lines. And I do think the partnership with the CFO is incredibly important. The partnership with investor relations, because this is sustainability goes to the heart of performance. And I think Larry Fink said it best in his letter, where he said there's no company that isn't going to be impacted, for example, by a transition to a low carbon or zero carbon economy. And so that partnership and understanding the investments needed, the time horizons, the opportunities, the costs, the risks will be extremely important, I think.
Does Larry Fink's letter make a difference in your world?
I think Larry Fink's letter is very aligned with how we think as a company. In terms of the actual broad scale of the impact and the amount of investment and change that's needed to affect the change.
Well, lots more to talk about on this topic, as we will in April at Greenfin. But for now, thank you for your leadership and your partnership and modeling what it takes for a company to be seen as a leader in ESG these days. Martina Cheung from S&P Global. Thanks. Thank you very much.
Thank you.